planning. We are going to go ahead and get started because we've already lost a lot of time. For those of you that don't know about me, my name is Irs Audits, and I'm the Chief Cook and Bottle Washer for the Wealth Building CPA. I help a lot of real estate investors, and that's what I've been doing for the past couple of years. This program really is meant for those in the wealth building program, but we did open it up to some people who are not in the wealth building program. And so we're going to go ahead and get started. Of course, we talk about the ultimate wealth building program. You want to make sure you're doing your financial needs analysis, you're doing tax planning and preparation, entity structuring, business registration, business analysis meeting, investment property purchasing, retirement planning, year-end tax planning. Okay. And then what we're going to be focused on today is stage 8 of the wealth building program, which is the year-end tax planning. We tell people that April 15th is your tax filing deadline, but December 31st is your tax savings deadline. So whatever you don't put in place between now and the end of the year, you're pretty much just dealing with compliance during tax time. That's why we are usually as busy as we are September, October, March, April, as we are in December, because we want to make sure that a lot of our clients, one, you're able to see the picture. For some people, they may not need to make any change, just their awareness, but other people, there's things that you need to do before year end to save on the taxes.
Barry?
Yes.
Excuse me, sorry. Is it possible to go into slideshow mode so this is a little bit bigger?
I can, but what usually happens is because I'm sharing the screen, if I need to type in and stuff, then I'm not able to do that.
Oh, okay.
Because I have to keep going, if I have to keep coming, going in and out. What we do is we can make the slide, we'll make the slides available because everything that's on the slide I'm going to discuss, but we will also make it available to everybody at the end. And then I'm going to try to increase it here too.
That's better.
Okay.
That's a little too big, right there. Yeah.
Okay, let me take it down. Okay.
Okay, thank you.
All right, so the first thing is if you own a business, you have an EIN number, an operating agreement, separate bank account. IRS audits are on the rise, especially for real estate businesses. I cannot overemphasize the importance of making sure that you have a separate business and you're running your business in a professional manner. Have you recorded all of your income and expenses related to the business on the business bank account? This is a huge audit item for 2021. If you own investment property that was foreclosed or sold as a short sale, have you considered the impact of cancellation of that income? And have you calculated that loss? If you generated any kind of active real estate income, have you considered restructuring your business to minimize the impact of self-employment tax? And what we're talking about here is for those who are usually doing like the wholesaling, my rehabbers, my realtors, you know, are you looking at the S Corp structure? Are you looking at the multi-tiered, multi-member LLC tiered structure to be able to split your income between what is active income and passive income? If you have significant business expenses and already have a registered business, have you considered converting to a multi-member LLC to avoid audit flags? Have you considered the impact of wasted deductions? Do you understand what your tax filing requirements are for the states where your business is registered? If you own investment property, have you considered doing cost study or increase your depreciation expense? If you bought or sold property in 2021, have you considered the impact of capital gains, rehab expenses being added to the basis of your property, and whether the holding costs are deductible in 2021? So those are the items that we have first. So I'll pause now to take any questions that anybody has, and then we can take it from there. Does anybody have any questions based on what we've shared so far before we move on? You can type it in the chat or you can just unmute yourself.
Will you be
Okay,
going
oh,
over each of those in that list during this call?
Keith, were you saying something? You need to speak a little louder, please.
Will you be going over each of those in this call, each of those items on that list?
Sorry, say that. Oh, am I going to be going? No, not necessarily. Only the items that you guys think may be of importance. We have about 45 people on the call today. So I would only highlight the ones that somebody says, hey, can you talk more about this? Because we have several sections that we have to cover today.
Right.
So what I'm going to do is I'm going to share my screen again and let you guys look through it. If there's a specific area that you want us to cover, you can ask me about that before we move on.
I did have a question,
Mhm.
because I do real estate.
Mhm.
So I'm in your real estate pool, but also have investment properties.
Mhm.
And then, and I don't know at what point I should talk to you about this, but the property management company that has nothing to do with my real estate. And so my real estate, I guess, is viewed maybe as a sole proprietor. I'm not sure. So as far as like, if I need to change the structure or merge it under the property management or whatever, I'm not sure what the right place, I don't know what to do there.
Okay, so let's talk about the different business structures. So I got property management, then what else?
I do real estate. I'm a realtor, real estate professional.
So you're
But
a realtor or a real
yes,
estate investor?
no, I'm actually, I have rental properties, but I also am a realtor.
Okay, so let's exclude the rental properties because that's a passive investment. So we're only looking at your project management income and your realtor income.
Okay.
So in terms of the income that we consider, we don't really look at your rental property income because that is a passive income investment. It doesn't count in the active income that we're looking at for consideration.
Okay.
And so your question is whether the project management income and the realtor income really should go together under one umbrella?
Yeah, it's property management, but the property management is really primarily now of my properties.
Mhm.
And so, yeah, I was wondering if I should merge, because right now I don't have like a business name for my real estate stuff.
Okay, so my suggestion is that because both of them are active income, so this includes my rehabbers and my wholesalers, because project management income, realtor income, rehabber income, wholesaling income are all active real estate income, you really could combine those in one entity, because in those four cases, you're not really holding on to an asset. You don't have an asset that you're holding on to. What you have is income that you earn from it. One of the ways that you can distinguish it is by setting up a DBA under the multi-member LLC. So if you do a DBA, you can do a DBA for the project management, then you can do a DBA for the realtor income, one for the wholesale, one for the rehab income, but then all of them roll into that one parent LLC. So those are, that's one way that you can do it. And then also when you're doing your bookkeeping, you also want to keep those separate. Have those each recorded by class, because we want to see how each business line is performing and whether or not there's some things that we need to revise based on what's going on. And then of course, make sure that you have a good umbrella policy that covers everything that you have in the LLC.
Vera, can I clarify, when you say you can have a DBA to separate each of those different activities and separate the funds, is that a separate bank account for each of those?
You can do separate bank accounts if you want, but when we say separate them out, the DBA would actually be registered with the Department of State with SDAT. And then when you're doing your bookkeeping, it's going to be recorded separately. Even if you have one bank account, when it's time to do the bookkeeping, it should be kept separately. But the way that we distinguish it is by actually registering that trade name with SDAT and just have each separate line have its own name. So you guys know the name of our company to be Wealth Building CPA, but we also have ACE Tax Services. Those are DBAs of the parent company. Wealth Building CPA is what handles services to real estate investors. ACE Tax Services handles more of like the walk-in clients and all that. So the compliance tax preparation aspect. Different DBA names, one entity. And then we keep those, we track those separately.
Is that a holding company? Your ACE, I mean, your Wealth Building CPA, is that a holding company of the others?
No, both of them are trade names. And I will not tell you the parent name because I don't want you going to sue me.
Right, that's my question.
So, yeah, so it's not, those are both trade names of the parent company. The parent company's name, we hardly use it anywhere. So nobody, unless somebody goes digging, we really don't, that's not a name that we use out there. It's also for asset protection. We only use the trade names when we're doing business.
That's what I want to do. I want to set up a holding company, and then everything else is a different company. I don't want to own anything. I want my holding company to own things, right?
Yes.
Okay.
Yes, and that's the way to go. Yes, absolutely.
Okay, so in the scenario that you described, all of those have the same EIN number?
Yes.
Okay.
Yes, they all have the same EIN number. Yes.
Okay, so right now I have the properties under, and I'm not going to monopolize this last question for me, but have the properties, the rentals, which you say are passive, so we're not really talking about that, but they're under a revocable trust right now. And so would it make sense just to leave those there and concentrate on doing everything that you just talked about for the real estate related?
Yes, the way that we handle properties that you own are completely separate. We don't even want them as part of this active LLC. So having them under the trust is fine. And if you wanted to have another LLC that was the beneficiary owner of the trust, you could do that. Or you just have them in the trust name the way that it is right now. The only thing is that the trust gives you privacy. It does not give you asset protection. So that's why maybe if you want to do like a separate LLC that is the beneficiary owner of the trust, then you've added that extra level of protection rather than having, because with a trust, that veil can be pierced because it's not really an entity.
Oh, wow. Okay. Yeah, I was going for the protection. That's what I was going for, was the protection. If something happened to me, the trust is still standing and the properties are in the name of the trust. So you're saying it really is not protection.
It is protected a little bit because it's private. If people don't know who the beneficiary owners are, they can't come after it. But and not to digress, because I know this is not the purpose of this meeting, but let me just cover it quickly. There's two kinds of creditors. You have the bottom-up creditors and the top-down creditors. The bottom-up creditors will not be able to come after you, but the top-down creditors can come after the trust. So if the trust has like a $500,000 equity, yes, they can come after you, but they can go after the trust. So you want to make sure that you have an extra level of protection, because putting it in the trust has taken care of 50% of our problem. It has not addressed the other 50%. And the other 50% is they can still access the equity that is in the trust. That veil will be pierced. So that's when we start looking at umbrella policies and put in liens and having an LLC as an additional layer. But you can reach out to me. We can schedule to discuss that, or next year we'll schedule an appointment just to talk about entity structuring, since we're focusing more on year-end tax planning.
Okay, all right. Thank you so much.
All right, I see a question here. So let me share the screen so I can address that. Somebody asked a question about number 6. If you have significant business expenses and already have a registered business, have you considered converting to a multi-member LLC to avoid an audit flag? So that's something that because what happens is that if you have a single member LLC, a single member LLC would file a Schedule C. And so if you're filing a Schedule C and you're claiming all these expenses and there's no income to show for it, you're raising an audit. So unless you're going to amortize those as startup costs, if you do have justification for being able to claim those expenses, you're better off with like an S Corp or a multi-member LLC. It reduces, not eliminate. So it reduces, not eliminates the audit flag, because Partnerships are not audited as much as single member LLCs, but that is changing because we understand now that they want to start looking at some partnerships because they realize now that a lot of partnerships are where real estate investors are doing business. So they're kind of like adding on more enforcement people to the IRS to start looking at the partnerships. But so far, your chance of an audit with a partnership is much, much, much reduced compared to your chances of an audit with a Schedule C. All right, and then let's look at number 10, then we'll have to move on. If you bought or sold property in 2021, have you considered the impact of capital gain, add-in rehab expense to the basis, and whether the holding costs are deductible in 2021? The reason why this is important, all of these things I mentioned here are things that come up as we look at people's returns. You know, and one thing that we've noticed is that sometimes people would sell a property and those property may be crossover multiple years, sometimes 3 years. And our clients will forget to go back and pick up all the costs that they had before. So we want to make sure, especially now, don't wait and do this during tax time. I'm trying to get our clients to the point of whenever you have a property that is sold, within 1 month of selling that property, you want to go ahead and get the capital gains worksheet calculated so that you can know exactly what it is that you're going to be owing. We don't want to wait until the last minute to figure it out. And that's because we have to look at all your costs when the property was purchased, the improvement cost, the holding cost, all of that. Get all that calculated now because it's not going to change. The property is already sold. So get that worksheet calculated now. And so we can see what impact and that we've captured everything. I had a client who, because they did that, they found, and theirs was because they sold 7 properties this year, they found almost $150,000 of deductions that they would have missed if they had not taken the time to do it now. And we're trying to do it during tax time, because guess what? I don't care what anybody tells you. I'm going to be very honest. We are stressed out during tax season. Tax season, March, April is not the ideal time for you to be filing your return. You either do year-end tax planning and then you wait till the summer or September, October to file your return. Trying to beat the rush with everybody March, April because you're trying to get a refund is not an ideal thing for the real estate investor. So it's very important that if you already have a property sold in, send in the HUD ones. Let's do the calculation now. If we don't get to it now, if you didn't do the year-end tax planning, we can at least do it in January, know what that is, and that keep that in the files for when tax season rolls around. Okay, so moving on. Now we're gonna invite Ryan from Canon to go over the advanced tax strategies. Ryan usually assists me in working with our clients. After we've done the initial tax planning and we've done all we can, we will now have him come in and look at the returns and see if there's additional strategies. So these are some of the items that he's been going through with our clients. So I'll have Ryan go over them right now. And I see somebody asked a question on the chat. Don't worry, when we're done with this section, I'll address your question. So Ryan, thank you for coming.
Yeah, thank you for having me. I really appreciate it. So I'll just go through each one of these. The oil and gas is dealing with the drilling contracts, and it's really good to kind of offset a lot of different taxes. It's good for W-2 earners where they can get a dollar for dollar tax deduction. So let's just say you put $25,000 in, you get a $25,000 tax deduction on your return. And then it's going to start cash flowing the second quarter, and they pay out quarterly. So starting in the 7th month of next year, which will be in July, it'll start cash flowing quarterly. So the kind of the goal there is to get the return on your original investment plus interest, and the interest, I would say probably on a conservative level is average somewhere between 10 and 13%. It's done better than that, but I like to kind of under promise and over deliver in terms of the interest on that type of investment that has the tax deduction. 1031s are great. A lot of people will 1031 into another investment property. Another idea, we kind of call it like a 1031 rescue, is to 1031 into a DST. So it's a Delaware Statutory Trust. And what that allows you to do is that you're going to invest into an investment property that's already been set up, except you don't have to sign any loan documents. You don't have to worry about tenants or toilets or trash. You just get the monthly cash flow that way. So that's also a nice opportunity for some people that like the idea of getting the monthly income, but then also don't like the headaches of being a landlord. Third topic, a qualified opportunity zone, also paired with a oil and gas drilling contract. These are really good for people that incur capital gains, could be short-term gains, could be long-term. And these can be realized up to 180 days after the gain has been realized. So it's a good planning thing that we can do. Let's say you realize the gain here in December. There's some things that, December 31st comes by and it takes some of the planning opportunities off the table. What the opportunity zone does is it allows us to go into 2022 and kind of go back in time to affect the tax return for 2021 when the gain was actually realized. There's some special things with the oil and gas. There's a lot of different ones that are out there. I kind of like the oil and gas just for the fact that it cash flows sooner. So you're going to be looking at cash flow the first year. You're also going to see special deductions when the taxes are due. Usually if you get it in place by 12/31, you get this 10% step up in basis in year 6. So when taxes are due in year 7, now you're looking at 90% of the original gain that's going to be taxed. Well, you're also going to get depreciation, depletion allowance, and then also you're going to get discounting. So you're looking at maybe paying 40 to 60 to 70% of the original taxes that were due. Plus you're going to get the cash flow. Then after 10 years, you're also looking at kind of like a Roth situation where you can pull the money out and it's tax-free totally. So charitable structures, a lot of different charitable structures out there. It might be hard to try to set something up that's a little bit more formal, like a foundation. There's charitable remainder trust, charitable lead trust, there's donor advised funds. We've got a few other things that kind of take into consideration, a little bit easier. So we have quite a few different things there, but the idea is to try to maximize your itemized charitable deduction so that you can get something higher than just the regular standard deduction on your tax return. And the number 5 is a defined contribution plan, have higher limits in the 401k. We've got quite a few different ones that we have access to, looking at a profit sharing plan, looking at a cash balance pension plan. There's even like a hybrid cash balance pension plan that has like a life insurance component plus the investment component built into it. But then you could really look at, adding or being able to get a deduction of about 100, 200, 300,000, maybe even higher for all of that, getting that set up. And that can be in addition to a 401k plan. I know I work with a lot of clients that, they've got W-2 income because they work at an employer, but they've also got investment income. They've got another side business is doing really well. Maybe they're a consultant or something like that. So they can contribute to the employer 401k plan, but then we can set up through their other business, a profit sharing, a cash balance, and being able to put away a significant amount more money.
Right.
So I think some questions come in. Yeah, go ahead, Keith.
Yep. Is it possible for me to set up my own charitable organization and any income from my investment, put it there, and then pay myself as a part of that charity?
You wouldn't necessarily be able to pay yourself, like in terms of like you're talking like a W-2 or payroll or something like that.
Some way to take advantage of, yes, it's a charitable business or what have you, I'm doing something, but there's costs involved, to run that. I was just trying to figure out how would I pay those costs of my time.
It could be possible, but yeah, there's a lot of, like whether it might be like a foundation per se. So it is possible to set up the payroll, but then you also have to have like the separation, because there's some rules to follow, but it is possible, or we could explore it, because there is a right way to do it and a wrong way to do it. I know like how the IRS looks at it is if they look at it and this looks like that you're just trying to hide money and
Mhm.
pay yourself a different way, they're going to come.
Yeah.
They don't like that, but there is a right way to do it and there's a wrong way to do it. And it's also, I mean, there's different trusts that you could take a lump sum, put it into the trust, and then you're going to get an income off of that for the next X amount of years, whether it's 5 years or 10 years or 20 years or life.
Mhm.
So there is a way if you have like a larger lump sum of money. So that, I guess that kind of comes into play. What if you have like a charitable organization that you're already kind of doing something with and maybe wanted to make it more formal? And then looking at, because I think a lot of it just has to deal with how much money is going into it. I had a friend that wanted to set up a foundation and we got the foundation set up and he's like, well, I was wanting to kind of get paid on it. I'm like, well, how much, he didn't have that much money to go into it. I mean, he's gonna be able to put anywhere from about, I don't know, maybe, I think we were trying to go over the standard deduction. So I think he's going to put about 35,000 into it a year. So there really wasn't enough of separation. Plus there just wasn't enough money going into it to really do it that way. But he is going to be able to maximize his itemized charitable deduction that way, plus pay out the scholarship that he was going for. So it's kind of like one of those things. I call it ID. It depends on the situation. And I'm sure there's definitely ways we could take a look at different options and bring a bunch of different options to the table and see what makes sense. And because a lot of times it comes down to like liquidity and control and all of that. So, but there is a lot of different options.
And then I think it also depends on the work that you're doing for the foundation and whether or not you're getting reasonable compensation. So if you're getting reasonable compensation, that money is still coming back out anywhere to you, then what was the use of sending it through the nonprofit in the first place? I do have a slide that's dedicated to talking about the charitable structures when we go a little bit further down, but to say that I want to set up a nonprofit, I'm going to contribute to it, I'm going to get the tax deduction, but then I want to be paid from that. Well, if you're paid from that, it's going to be the same thing. You would have to pay yourself a salary, which is subject to the 15.3% tax, and it still comes back on your individual return. So all you did was you just went around in a loop. And so was it really worth it? And then the next thing is whether or not it made sense in terms of reasonable salary, how much you're paying yourself from there and the kind of work that you're doing. Also keep in mind, I know that this is not what we're covering today. Keep in mind that depending on the kind of work that you have the nonprofit doing, you might be subject to UBTI, unrelated business taxable income, because if you're doing any kind of work that is not part of the nonprofit's exempt purpose, that is considered an unrelated business, and there's a flat 30% that you're going to be slammed with if you start generating income and it has nothing to do with the nonprofit's purpose. So let me go back. I know there's a couple of questions. There was a question here from Laurie about the impact of the holding cost. The reason why I brought that in is that sometimes you might, okay, so let's use 2021, for example. You purchased the property in 2021. You're either going to rent it out next year or you're going to sell it next year. Now, all of your holding costs, the mortgage, interest, taxes, insurance, will not be deductible in 2021. Right? You bought it in 21, you have holding costs in 21, but you're not able to deduct it because that property is not yet placed in service. Until that property is placed in service, if it's a rental, meaning it's available for rent, or until that property is sold, your holding costs are just added to tax bases until one of these economic events occur. So if you bought a property in 2021, your holding costs will not be deductible if that property was not placed in service, meaning available for rent in 2021 or sold in 2021. Somebody asked about the oil and gas. So let me tell you how it works. You invest, so let's look at real estate and then we'll compare it to oil and gas. You invest $50,000 in real estate. You can only get a deduction for that property if the property is sold. And if it's rented, you get depreciation. With the oil and gas, because what you're investing in involves some kind of upfront intangible drilling, you can invest $50,000 and get a $50,000 deduction this year for investing in oil and gas. What I tell people is that there are ways to save you taxes, but money has got to be flowing out your pocket. It's either going to be flowing out your pocket by you making these kinds of advanced investments, or you're investing in a retirement account, or you're giving back to charity. So it involves money that you're not going to give to the IRS, but you're either investing it somewhere, somehow. So the advantage of the oil and gas is more for our clients who you're looking for additional deductions and you don't have anywhere else to get it because maybe most of your real estate is rental properties. You make over 150 grand, you're not able to claim the losses. Well, if you invest in oil and gas, you're able to get that upfront deduction for 2021. In addition, you're going to do your due diligence to make sure that that oil and gas is a worthwhile investment. But so far, they're looking at 7 to 10% return over 10 years. Somebody wanted to know what are the next steps for the oil and gas.
I'm sorry, Ibarra, before you move forward, I kind of fit that category that you mentioned. So can you explain how I would invest in oil and gas so I can take some tax advantages?
Yeah, so that's what we were going to talk about because the next person asked the same question. What are the next steps for oil and gas before end of year? So Ryan, can you explain how to do that and then add your information on the chat? If you guys also want to reach out to me directly, I can connect you to Ryan directly.
Yep. The minimum investment in the oil and gas is 25,000. So basically we would just have a meeting together. I'd go a little bit more in depth, get you some more information. And after that, it's a pretty easy process of just filling out an application and then have the money wired to the institution and everything. And we just kind of go from there. I do have a 3.5% planning fee that we add on there. But since we don't participate in commissions with the broker dealer, you actually get like a 7% bonus on top of any money that you put into the actual oil and gas. But I could even go over that a little bit more. Let me put my calendar in the chat.
And yeah, I see a couple of people asking about that. If you guys indicate interest and let Ryan know that you came from me, we can actually set up another webinar just to talk about the oil and gas and deal with it in detail. But
Absolutely.
One of the ways of looking at it is that you invest 25, you're going to get at least 90% of that money as an upfront deduction. That's the benefit of investing in oil and gas versus in real estate. I do have a couple of clients who have done the oil and gas, so that if it's something that any of you are strongly considering, we close next week, but we can set up an appointment like on Friday or next week, Monday. Ryan and I will be on the call. We'll have a client who has done this before on the call to answer all your questions. But the main thing to note is that you're going to get a K1. And in that K1, you're going to get an expense deduction that's almost equal to the value of your investment. That's the benefit of investing in an oil and gas, in addition to what we already do in real estate. So I see, Laurie asked that question, Flo asked that question, Agnes asked that question. Erica, anybody that has additional, or you want us to do another quick webinar on it, I can get my clients who have done the oil and gas and use that strategy so they can explain to you how it works. All right, so somebody for the charitable structure, are you actually contributing to the charity, or is it the expenses that are being? No, you're actually contributing to a charity, and then you're able to get a write-off for the fair market value. There's some other structures that we're looking at, and I'll cover that in a second, but you're actually contributing and being able to get that deduction up front. All right. I'm a government contract consultant and teach a course at college. From what I'm hearing, these costs should be under real estate type of things that I do. I'm government contract consultant and teach a course at college. From what I'm hearing, these costs should not be under the real estate type of thing. Yes, because these are separate. The government contracting is separate.
Right.
Teaching a course
Right.
at a
Because
college is separate. Yeah.
I'm wondering if it's separate, because it looks like the other real estate related things I'm doing can go under the property management, but the government contracting and consulting and those kind of things right now, I guess I'm a sole proprietor, so I was wondering if that should also be under something.
Yeah, those will be separate. So you can contact me and then we'll talk about it.
Okay,
I see a lot of you have indicated interest in the oil and gas. So you either reach out to Ryan directly, or Ryan and I are also going to get together and see if we can have a quick meeting so that you're able to invest it before year end. Yes, somebody wanted to know, can you do it before year end? Yes, that's the whole reason we're having this meeting, so that you're able to invest it before year end. I'm also writing you guys' name down to be able to get back to you later on. Okay, so, okay. Yeah, I have all of you guys' names about that. Okay, so I have Eric and Agnes to clarify. No, not $25,000 a year. You just make $25,000 for this year, for 2021. You get that as a deduction, as an upfront deduction, and then you just wait for the return on investment. So it's not something that you do yearly. Now, if you want to invest in oil and gas yearly, you can. It will be separate investments, just like you have separate real estate investments. Pamela, I got you.
Okay.
No, you do not have to be an accredited investor to invest in oil and gas. Okay, keep going. Keith, okay. Thomas Holbith. Hold on, I'm getting you all's names. So it looks like it's all of you. So we might as well just schedule another meeting to just talk about it. Okay. I am going to talk about the different charitable organizations shortly. We have a slide for that. So let's move on. Oh, we have 21 new messages. Too many of y'all typing. Okay. Everybody's telling me that they're interested. So what we're going to do, please make sure that you are in our database, because I think the best way for me to handle this, rather than trying to get everybody's name, we have to move on. Either you contact Ryan directly, so he has your name on the list, or you email me, or please make sure that you are in our newsletter and our database. So however you got information about this meeting, we'll send out the same thing about the meeting so that we can notify you appropriately, so we can move on. Okay, next screen. Okay, so other things to look at for year end, just remember that the child tax credit, some people got the advanced child tax credit this year. Just keep in mind that whatever you got for the last 6 months is going to be deducted from your refund. So make sure that you have that information. In January, you're going to get a form that tells you how much you got in the advanced tax credit. It's advanced, so that means that whatever you would qualify for on the return, that amount will be taken out of it. Then the child and dependent care credit for 2021 is now fully refundable. The maximum credit percentage has now moved from 35 to 50%. For unemployment compensation, just know that last year you could deduct $10,200 if you made less than 150K. Unfortunately, we don't have that for 2021. So any unemployment compensation that you received for 2021 would be fully taxed. For the student loans, normally if a student loan is canceled, forgiven, or discharged, the amount of canceled debt is considered income. However, for 2021, this rule is suspended for most canceled student loan debts that you incurred. So it's 2021 to 2025, I believe. So it starts again in 26. So I did a special slide on different ways that you can give by the end of the year. So we're going to look at all these. And then if you have more questions, then you can ask me. So you can either give cash. So everybody knows about that, donate to a nonprofit, but you can get involved by investing in a donor advised fund. So this involves you giving cash or security to a nonprofit through a given account. So the way it works is that you set up the donor advised fund with any of the brokerage companies. Most of them have it. That's something that we also offer. So you set up the donor advised fund, and let's say you want to contribute $30,000. You contribute the $30,000 to the donor advised fund. You're able to get it as a deduction this year if you get it done before the end of the year. However, you have time to designate the nonprofit or charity that would receive those funds. So the benefit of doing it through a donor advised fund is that you're able to get the deduction for this year, but you're able to get the deduction for this year, but you necessarily do not have to designate the charity until later. It also can function as an investment account, meaning that you have, so let's say you contribute $30,000, you can invest it in stocks and oil and gas and any of that stuff. So the money is growing, but all of that money would need to go to a public charity. So it's also a way for you to do like a legacy giving, where you're not just giving cash, but you're also giving equity to a charity. So there's different kinds of funds that you can set up. You can do the Daffs that are over 25K. You set this account up individually on your own. It would cost anywhere from $750 to $1,500. You can do under 25K, and it will just be pulled with other people who want to do a Daff, and the fee is from $300 to $1,000. Now, another thing that you can do for those who want to contribute this year, but you haven't quite decided where you want to make the contribution, you want to do it within a year, rather than doing a donor advised fund, you can set it up with a nonprofit, and we have a nonprofit that can do that for you. You do a directed contribution, meaning that the money would go to whatever charity, persons, individual causes that you designate, but you have to do it within a year. So you're able to get the deduction this year, but you have time. So using a donor advised fund enables you to separate the charity that you want to give to versus the deduction that you get by donating. So you donate it now, get the deduction now, but you have time to decide on who gets that investment. All right, so just moving really quickly with the estate planning, make sure that your estate planning is up to date. Do you have your will and trust? And are your fiduciaries, trustees, beneficiaries still the same? Do they need to be updated? Does your healthcare directive include HIPAA rules? Is your financial power of attorney up to date? You know, your beneficiary designations, if you had a significant life event, have you updated those on your life insurance, retirement accounts, bank accounts, vehicle, real estate? And then review your car and homeowners insurance policy. And it's possible for you to get more coverage or get a reduced fee by looking at that. There's additional savings by doing all these things by year end. I just wanted to talk real quick. This is exciting news. I'm partnered with a couple of my clients. We purchased a self-storage facility in 2017. We sold it September of this year. And let's look at the timeline of what happened. So this was something that we started 2017 to 2021. So you can see here the timeline of everything that happened. The bottom line was that we received about 1 million at closing. I think we purchased it for 2.5 and sold it for 3.5. And then we were able to get a 10% annualized return. So relationships matter, you know, partnering with the right people. Real estate still matters. You can do it by yourself, but you can also do it as a joint venture. I think that's it. Anybody here, if you're interested in joining the wealth building program, please feel free to reach out. I'm not necessarily pitching the wealth building program. We are actually overwhelmed, so I may not be taking any new clients, but you can still reach out, and we'll see some people cancel out of the program and we can fit you in. But today we wanted to make sure that we gave you all of the attention you needed for year-end tax planning. So that's it pretty much. What I'm going to do is stop sharing my screen, and then we will just answer questions until we're done. Okay, so somebody asked, does Daffs help with capital gains when selling a rental property? Yes, because once you've sold a rental property and now you have all these taxes that you have to pay, you can go ahead and contribute that money to a donor advised fund so that you have capital gain on this side, but then you have a charitable deduction on this side, and that can net out each other. But you do want to make sure that you were planning to give that money to charity. Anyway, this is more of like a legacy planning tool. Somebody asked, what about retirement accounts like solo 401k? Yes, I covered that initially. That was in the very first slide about setting up 401ks and SEP IRA. You can contribute up to $63,000 to a solo 401k. And then if you wanted to do the defined benefit plan, the one that Ryan talked about, you can do up to 100,000. And in some cases, even more than that. So yes, contributing to a retirement plan is one way to save on taxes. Now for the SEP IRA, the defined benefit plan, you don't have to do anything before year end. Those ones can be done up till tax time. But for the 401k account, you need to have that account set up before year end. We set up the self-directed 401k, the one that you can use for real estate. We charge $9.95 for that. Or you can just set up a brokerage 401k. You go to, Charles Schwab, Fidelity, any of those companies can set up a brokerage 401k. So at least, if you think you might need it, get it set up before the end of the year. You don't have to make the contributions until tax time, including extensions. That's actually a strategy that some of our clients use, because you have up till September to make the contribution and it still counts for 2021. And what our clients do is that they just generate the money from their 2022 earnings in order to make that retirement contributions. Okay, somebody asked that I talk about digital assets and cryptos. That's a hot button topic going on right now. Just understand that digital currency works more like real estate. So if you purchase, if it's not one of those things that where you keep the money in the account, then you don't have capital gains. Every time you sell a cryptocurrency and buy another one, you have a taxable transaction. So you want to keep that in mind. Make sure that you do have your worksheet that lists all your purchases and all your sales during the year. It's not like the stocks or mutual funds where you can go in and out and not have a tax liability. Once you, even if you exchange a crypto and purchased, let's say like you did shopping, so let's say you bought the crypto for $50, but now you're able to go purchase a car or whatever for $5,000. You do have capital gains that you have to report, even if you used it to buy another asset outside. That's the extent of, what I need you to know now about the cryptos. I'm making sure that you're keeping track of your basis in the cryptos, because they don't function like the other accounts, whereas until you sell it for cash, whatever activity that you have within the crypto, the IRS considers it a taxable event. All right, Ryan says that he has to jump off. Does anybody have any quick questions or anything? If not, you can reach out to Ryan later on. I do have his contact information. I can connect you. Like I said, we'll try to get together about this oil and gas. Maybe not this Friday, maybe on Monday, so we can talk about it. Somebody asked,
recording. I'm sorry.
Yes, we're going to send the recording. Yes. Would the 1031 exchange help someone who sells their rental property by December 31? It will, because you still have the 45-day requirement to identify the replacement property. And then you have 180 days, which is June 30th, to close on the property. So what happens is that you will not file your taxes until you have invested in the replacement property. So if you close on a property through December 31st and you have capital gains, by February 15th, you need to identify the replacement property. By June 30th, you do need to close on that property, but it means that you cannot file your tax return until that has happened, because we need to figure out, are you going to pay taxes on it or are you not going to pay taxes on it? So if you're able to pull it off, then you can file your return and exclude that gain. But if by June 30th, it failed or something happened, or you couldn't do a partial one, then you would have to pick it up. So you file an extension if you have a 12/31 closing and want to do an exchange. Okay. Yes, the recording will be available to rewatch. So everybody that registered, we will send you a copy of the recording. So feel free to download it and listen in. All right, I think that's it. I'm tired.
Oh, I had
Anybody have
one.
any other? I'll just take any other questions until, so we should be wrapping up here in the next 5 to 10 minutes.
Okay, I just threw one in the chat real quick that I can ask you. Okay, if I sell a Georgia property, does that investment property, does that impact my Maryland taxes at all?
Yes, because you're a Maryland resident, you're gonna pay Maryland taxes on that Georgia sale, but you get a credit for whatever you paid in Georgia on the non-resident return. So you get credit for taxes that you paid in Georgia. The downside of it means that if Maryland tax rate is higher than the Georgia tax rate, you end up being stuck with having to pay taxes at the Maryland rate on the Georgia property because you are a Maryland resident.
Okay, thank you.
Yes, and one question is, can you set up a health savings account and get a deduction for 2021? Yes, and you have up till tax filing time to set up the HSA and make contributions to it. I know that because I just did the research a week ago. So yes, you can set up an HSA up until tax filing time.
Can you go back to that question about the, you have property in a different state? Is that the foreign entity tax?
No, Maryland, the foreign entity tax is if you were not a Maryland resident and then you sell a property in Maryland,
No.
then they would withhold taxes, the non-resident withholding that you get during tax time. So that's one aspect. So if you're LLC or yourself, you don't live in Maryland and you own a Maryland property, then the title company will withhold 8.5% of the proceeds at closing. That's why if you have a property in Maryland and it's owned by an LLC that is not registered in Maryland, you want to register it as a foreign entity in Maryland to avoid having that tax withheld. But if you don't do that, the taxes will be withheld. And then when you calculate your capital gain, you'll get that back. Her question is the other way around. She's a Maryland resident and sold a Georgia property and wants to know whether she's going to be paying Maryland taxes. The answer is yes, but she gets a credit for the amount that she paid to Georgia for that property.
Okay, thank you.
Any other questions? Oh, sorry, I see something here. If you contributed maximum to a 401k for a W-2 and you have a 1099, can you still set up? Yes. So if you contributed the max, there's two parts of the solo 401k. There's the salary deferral portion, and then there's the profit sharing portion. The salary deferral portion does not change. You know, if you have a regular job and you're doing it at your regular job, you can't turn around and do it in the business. So if you're under 50, the 19,500, if you're over the 26,500, that you're able to contribute. However, you are able to still do the profit sharing piece in the 401k, which is also equivalent to doing the SEP IRA. So what you might want to consider is that if you maximize the salary deferral piece at your job, then what you want to do is you can do a SEP or a solo, because in that case, you're only going to be able to do the additional 25%. Now, here's some strategy that some of my clients use. They would only contribute to their job the amount that is being matched by their employer, so that the rest of it can be contributed to the solo K, and it's now available for you to do real estate because you're able to self-direct it. So some people may say, hey, my employer is only going to match 10, so they match 10. So because they only did 10 at their job, they're now able to do the 9,500 in their business 401k plus the 25% of the profit sharing amount.
So which one of the retirement plans doesn't require you to be a certain percentage employee? Is there one like that that you can contribute to, but you don't have to work for that particular entity X number % of time?
No, if you have a single member LLC, multi-member LLC, S Corp, you can set up a 401k. There's no limit on that depending on the time that you work. As long as you
Okay.
have earned income from that business.
Okay, in the form of, does it have to be W-2 or can it be
No, it doesn't have to
1099?
be W-2, it just has to be earned income.
Earned
from
income,
it. So
okay,
it can be guaranteed payments, it can just be net earnings if you're a single member
Okay.
LLC. It does not
Okay.
have to be a W-2 for you to use that to calculate your contribution to the 401k.
So
Okay.
Amir, I could then take, let's say we're selling a property in next week or so. I could take the proceeds from that sale,
Mhm.
put it into my own 401k.
No, well, are we talking about rehab or are we talking about rental?
This is a sale. We just finished rehabbing. We're closing on Friday. A
Yeah,
sale.
so that's what I'm saying. It's a rehab, not rental, right? You're selling a rehab property.
Right.
Yes, so yes, you are able to contribute that into a 401k. We will still need to run the calculations. So please make sure you let David know that he has a scenario, an additional scenario that he needs to run. But if we're closed by then, we'll do it when we get back. The most important thing is making sure that that 401k is set up before year end. In terms of how much you can contribute and all that, we can deal with that, next year when we get back.
So just to clarify, and thanks for your time on this, I could take the proceeds, set up my own 401k. I'll do the company match thing for the 6%. I could take the proceed. Now, would that avoid taxes, get capital gains?
It would not avoid capital gains, but it gives you a deduction that would net out the capital gains. You're not taking the whole proceeds. Remember that you can't just contribute to a 401k. We have to do a calculation to let you know how much you are able to do based on your net earnings from self-employment. So if you close on it, you don't just go and set it up and contribute. You can just set it up and you don't have to have any money in there. It just needs to be set up by year end. Then you would need to reach out to us and say, hey, I want to do the 401k. We would look at the gain that you made from the sale of the property and then run a calculation for how much you get as net earned income from that and how much you can contribute. And then we'll present you with the scenario and then you choose if you want to do it. So it's not something that you can just go and do on your own because there's specific calculations on how much you are able to contribute from that property.
Got it. Okay. I'll talk to David about setting that up. Thank you.
Okay. So I report all of my income and expenses from my properties on Schedule E. My LLC is disregarded. Since I added my husband this year, can I report everything on the partnership return? Yes. So just make sure you let us know about that because if we're going to file a partnership return, remember that the extension for the partnership return is March 15th. So we will need to get you on the list as a new business that's filing a partnership return to make sure that you get the extension in on time. But the answer is yes, you can now report all those properties, move them from the Schedule E to the partnership. All righty, so thank you guys. If I don't talk to you guys again, Merry Christmas, Happy Holidays, Happy New Year. It's been a pleasure serving you. I will send either today or tomorrow the recording so you guys can listen. Please feel free to send us an email, reach out or call if you have any questions. All right, so I would answer this last question and then we're done. Can passive rental income not be contributed to a solo for? Yes, you cannot contribute passive rental income into a solo 401k because it's passive. However, we do have strategies that we can utilize where we can pay you a management fee and then you can contribute to the solo K from the management fee. But I want you to pay attention to this. If you have passive income, you don't pay self-employment tax. If we pay you a management fee, you now have to pay self-employment tax and then contribute. That's why we do the analysis to even see if it's worth it for you in the first place. Because now you're incurring a 15.3% self-employment tax that you're going to pay on that management fee income. we will now look at your regular federal and tax rate. If it's like 30%, then it makes sense because you're getting a 15% benefit. But if at the end of the day, your tax rate is only 20%, you've paid 15.3, you get a 20% deduction, you only benefited 5%. That's why it's important to run the numbers and make sure that it works for you before you actually execute. All righty, people. Talk to you later. For those of you that did the year-end tax plan, I'm sure I see a couple of you here, you have your year-end tax plan appointment coming up. If you do want us to send, a lot of these things I covered, we've sent them by email a couple of times, but if you need me to send them again, I will send them again. If you did not take advantage of the year-end tax plan, there's still things that you can do on your own, you know, to take advantage of these things before December 31st. All right,
Okay.
God bless and take care.
So if you missed the cutoff date for the appointment,